As an investor, you need all kinds of asset classes in your portfolio, short-term and long-term. After all, the idea is to make profits. Commodities are firmly back in vogue as the coronavirus pandemic led investors into safe havens. Tangible commodities and food have seen renewed interest. We bring to you all that you need to know on how to trade commodities and how the sector might fit into your portfolio. In India, trading in commodities makes sense for various stakeholders as nearly 58% of industry is directly or indirectly related to commodities, apart from the agriculture sector. So what is a commodity? Commodity is what you eat, wear, the transport you drive, the fuel you put in, wood, jute, etc. A commodity can be mined like metals, it can be produced like energy, it can be grown like agriculture and plantation. In India, you can trade all of these commodities, while globally, commodity exchanges also trade orange juice, cattle, pig futures, even weather futures. Commodities in India are traded on all the 4 exchange platforms, MCX, NCDEX, BSE and NSE. And you have a wide variety of products to choose from, futures and the recently launched indices. So while commodity is a part of your day-to-day life, when it comes to investing or hedging into commodities, there still are some myths there. Remember, commodity trade can be used by all stakeholders, namely the producers, traders and consumers like me and you. The next big question is, why should you trade or invest in commodities? You should, as it provides a diversification in your portfolio. Commodities are a great hedge to inflation. As recent times have shown, more stimulus leads to higher prices in tangible commodities. And since commodities are globally traded, this can be your way of having a piece in the global linkage. The world over, commodities are bigger markets in size and volume than equities. The difference between trading commodities and equities is that commodities trade is cyclical, short-term, and the focus is on hedging or making profit through price change. You rarely own commodities, while in equities, usually our long-term focus is on ownership of a firm. The top 5 traded commodities in the world are crude, steel, and copper. Gold is at a number 7, but in the Indian markets, gold is a top traded commodity, followed by crude and then copper. In agri-commodities, the ranking is oilseeds, pulses and guar. If you are new to commodity trading, start with something that you are familiar with, like gold. Start with a gold mini 100 grams contract. So if the price of gold per gram is 5,000, then for the 100 gram contract, it would be 5 lakh rupees. But commodities are highly leveraged products. So at a 8% of an initial margin, you can trade that 5 lakhs with just 40,000 rupees. Buy one gold mini contract. Gold has been moving nearly 2 to 3% on a daily basis. So if the price is gained by nearly 150 rupees per gram, you stand to gain 15,000 rupees for that one contract. But remember, gold is a compulsory delivery contract. So if you don't want to take the delivery, you have to wind up the positions 5 days in advance, or you would be marked for delivery, where you would then need to pay the full 100 grams amount and you get a physical delivery of a 100-gram gold bar. You can also follow similar steps for a trading position in crude oil, but just remember that the initial margin here is 10% and you will not get a barrel of oil delivered to you when the contract expires. So whether you want to buy gold as a financial product or hedge your portfolio, petrol, diesel, currency moves with the crude, you can do it with commodities, and that too with a high leverage.